Alpha Kappa Alpha Sorority Incorporated, Kappa Omega Chapter, Target 3, Building Your Economic Legacy presents Money Mondays. Welcome back. Last week, we helped you start a budget, monitor your expenditures, and hopefully that helped you save some money. This week, we're going to talk about ways that you can take those savings and start investing. There are 6 basic categories of investing. They include cash and commodities, bonds and securities, investment funds, the stock market, real estate, and retirement plans. Let's take a moment and look at each one. Cash and commodities are typically considered low-risk investments. So if you're new to investing or risk-averse, one of these options could be a good place to start. Keep in mind that low-risk investments also tend to have low returns. Commodities include things such as gold, silver, and crude oil. Commodity investments are based upon scarcity and fear, and these type of investments are completely impacted by political actions and environmental changes. CDs and bank products are short-term investments. They only yield about 2% returns per year. The third type is cryptocurrency. Cryptocurrency is the newest type of investment, and they are unregulated digital currencies bought and sold on cryptocurrency websites. The most popular one is Bitcoin. Bonds and securities are other types of low-risk investments. Bonds can be purchased from the U.S. government, state and city governments, or from individual companies. Mortgage-backed securities are a type of bond typically issued by an agency of the U.S. government, but can also be issued by private firms. A bond might only net you a 3% return of your money over multiple years. This means that when you take your money out of the bond, you'll have less buying power than you did when you put it in because the rate of growth didn't keep up with the rate of inflation. Investment funds are made up of a pool of money collected from multiple investors that are then invested into many different types of things, including stocks, bonds, and other assets. The collection of investment typically tracks a market index. This includes mutual funds, index funds, and exchange-traded funds. There are 2 direct ways for you to invest into the stock market: stock options and buying stock shares. So you purchase, you become part owner. So when the company makes money and loses money, so do you. Stock options occur when you purchase an option into a company. You are betting that that price of that company's stock will go up or down. Purchasing an option gives you the option to buy or sell shares of that company at a set price within a set time frame without actually owning the stock. Real estate investing involves the purchase, ownership, management, rental, and or sale of real estate for profit. Real estate is an asset form with limited liquidity relative to other types of investments. The hardest part about investing in real estate is finding a property that you can purchase with a margin of safety. If you can do that, you can make some decent returns investing in a property. You can make money by buying the property at below market rate and selling it at full price, as well as by renting or leasing the property to tenants. Crowdfunded real estate investment opportunities are beginning to pop up, providing new types of investments for those that want to invest in real estate but really don't have the cash. A real estate investment trust, or REIT, is similar to a mutual fund in that it takes the funds of many investors and invests them in a collection of income-generating real estate properties. There are 2 major types of retirement accounts: a 401k and an IRA. Both accounts are made up of cash that you put aside and then invest in various ways. The risk and reward of retirement accounts are completely dependent upon what they are invested in, which can vary greatly. Annuities are a contract between an investor and an insurance company, where the investor pays a lump sum in exchange for a periodic payment made by the insurer. They are typically used to supplement income and lock down a steady monthly payment during retirement. There's no risk to annuities, but there's no real chance of return either. They are simply a way to set aside income for retirement, not ensure growth. While annuities may be helpful for some retirees, they are not an ideal investment option for beginner investors or a way to grow your money. Now we know the options of the things that we can invest in. But what about those things that we don't need to invest in? A good rule of thumb is anything that will get you in debt or give you a quick ego boost is a bad investment. That includes that fancy car that you don't need or those fancy clothes that you're buying just to keep up with the Joneses. Remember, we're talking about building an economic legacy. Those are temporary fixes. We have long-term goals. So come back next week as we talk about financial literacy for kids. And always remember, we help each other. Bye for now.